Welcome to Trading Nation. I'm Brian Sullivan. We're joined by Chris Harvey, Wells Fargo's head of equity strategy. Gosh, where to start on this one, Chris? I mean, record highs every day. What, 56 new records this year for the Dow. NASDAQ up 30% this year. Global markets everywhere reflating. I think only Russia is the only semi-major market that is down year to date around the world. Where do we go from here? I'm running out of questions, my friend.
It's all good. It's all good. I think we go a little bit higher. We recently raised our price target to 26.36. We don't see a lot of bad news in the short term, and so we feel it's fairly justified. The other thing that we're seeing is just some of the behavior and what we're seeing from passive. We've had a lot of conversations about active versus passive, but one of the things that we just kind of stumbled upon recently is the dynamic behind passive, the trends that passive are starting to influence in the marketplace. And what we're seeing, it's very similar to QE. We put out a note talking about how passive is a new QE. And with QE, you took a certain part of the treasury market out of circulation. Now what you're doing is you're taking a good part of the equity market out of circulation, and you're upsetting the supply-demand dynamics. There are fewer natural sellers, and as a consequence, you're putting upward pressure on price. So a lot of what we're seeing is positioning, and what we're also seeing from the buy side is behavioral. So a lot of our clients are saying this is a good year. This is a very good year. Best year in 3, 4, maybe 5 years. But what they're saying is every time we tried to reposition a portfolio, every time we sold, it hasn't worked out so well. So we're stopping that. So you're seeing you're basically seeing a seller strike in the marketplace by a lot of active managers, and you're seeing the marginal driver, passive, pushing price higher.
Any sense, Chris, they're going to leave anytime soon, all these buyers? I mean, at some point, do we run out of money to invest? People literally say, you know what? God, I've made 25, 30% this year. I've doubled my money since the financial crisis.
Right.
Let's just go to cash. How do you counter that argument?
So here's what clients are telling to me. No one wants to be the first one out of the pool. No one wants to de-risk at this point in time. And it's even coming from the asset owners. No one, as the market's going higher, this is an odd dynamic, but it is true. People are getting more bullish. And again, nobody wants to reposition it. It hasn't benefited you. And so you have this mindset of it's FOMO, fear of missing out. And again, it's creating a momentum dynamic. And again, getting back to passive, the other thing that we're seeing with passive, it's pushing the momentum higher. At the beginning of the year, an S&P 500 fund, for every dollar passive, 20 cents went into tech. Now, for every dollar passive, 25 cents is going to tech, and it's pushing the momentum higher, and it's hard to see an end in the short term.
Is there too much concentration in too few stocks?
It is a lot of concentration in a few number of stocks, but we've seen it a lot worse. Back in the late 90s, I would say it was even more concentrated than what you're seeing right now. So it's a concern, but it's not as big a concern as it was years back.
So you don't worry that Apple is in 200 and some ETFs, Facebook's in 200 and some ETFs, that many of these big ETFs are 30, 40% weighted to 4 or 5 stocks. It's not a worry for you, Chris?
We worry about a lot of things, that included. And what you have to do is, when you're positioning the portfolio, have a more balanced, have a more diverse portfolio. A lot of whether it's the ETFs or some of the funds that you're looking at are too concentrated. And I would agree with that. You need to take a more balanced approach. And especially as we look forward, what we're telling clients as we look forward into 2018 is to lower your expectations, because you're looking at 2.3 on the 10-year, investment-grade credit spreads at 100 basis points or less, and you tack on a healthy risk premium of 3%, you're only looking at mid-single digits. So we think that people need to lower their expectations. We also think they need to take a more balanced approach to things.
So you say you worry about a lot of things, which is good. You're paid to worry, Chris. You're paid to, so we don't have to. Your clients, not me, but you get the idea. Yes. What is your biggest worry right now?
Our biggest worry is that mindset that everyone is on one side of the boat. Everyone seems to be overweight tech. That is a consensus overweight, and that's a concern to us. The other concern is the complacency that we're seeing, that investors are slowing down their turnover. It's taking them a while to reposition their portfolio, and it's working, which puts them in a more... What's happening is inertia is becoming the most powerful force in the capital markets. A body in motion tends to stay in motion, and that for us is a big concern. We want to see people more paranoid. We want to see people more concerned and more nervous, and they're just not, because of what you were saying before. across the globe, within the United States, everything is good and no one's looking at the major risks. Again, as I said before, as the market goes higher, everyone's becoming more bullish. I think all the positive is starting to color people's beliefs and views, and they're not looking at risk in the proper way.
Chris Harvey, Wells Fargo. Chris, always a pleasure
to
get your insight. You're welcome back anytime, man. Thank you very much.
Thank you.
Appreciate it. Folks, thank you for watching Trading Nation. See you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.